Assalamualaikum, my name is Fatin Afrina binti Faizal, number matric 10D1824F1054. I will present about my company, which is AJINOMOTO. AJINOMOTO Malaysia BERHAD is a Japanese-Malaysian company that started in 1961 and is now a publicly listed oil company on Bursa Malaysia. It manufactures and sells a wide range of food products, including its signature Ajinomoto, umami seasoning for consumer, food service and industrial markets. The company is known for being one of the first Japanese company in Malaysia, holding a halal certification from JAKIM since 1965, and is committed to health, sustainability and global growth. We move to first company performance, which is current ratio. Current ratio equal to current asset divided current liability. For the year 2024, current ratio is 5.28 times. Meanwhile, year 2023 is 1.77 times. So as we can see, liquidity for the year 2024 is more higher than 2023. So we need to use the higher current ratio to indicate greater degree of liquidity. Second is quick ratio, which is quick ratio equal to current asset minus inventory divided current liability. For the year 2024, quick ratio is 4.54 times. Meanwhile, year 2023 is 1.27 times. So as we can see, the liquidity for the year 2024 is outstanding. It shows superior short-term stability. Meanwhile, in 2023 is a good ratio, but the lower than current year. So for the year 2024 has a quick asset or liquidity asset to cover its short-term debt immediately. For third company performance is account receivable turnover ratio equal to credit sales divided to average account receivable. For the year 2024, the account receivable turnover ratio is 10.53 times. Meanwhile, 2023 is 11.20 times. So, the collection efficiently was excellent for the year 2023 because the company was very fast at converting credit sale into cash. Meanwhile, the collection efficiency for 2024 is great but lower than 2023. So, the higher value of the ratio indicates the account receivable can be converted into cash more frequently. To continue the company performance of Ajinomoto BERHAD is inventory turnover ratio equal to cost of goods sold divided average inventory. For the year 2024, inventory turnover ratio is 5.17 times. Meanwhile, year 2023 is 5.19 times. So, the inventory movement for the year 2023 is moving faster. Meanwhile, the movement of 2024 is a bit slower. So, the efficiency was satisfaction, even the less competitive than previous year. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Aina Farisha binti Muhammad Razi and my matric number is 10D1824F1013. I will continue the company performance. Now, we will count the operating profit margin. The formula is EBIT, which is earning before interest and tax per sales and times 100. For the year 2024, the operating profit margin is 71.71%. And for the year 2023, the operating profit margin is 3.25%. And the conclusion is the margin is significantly outstanding in year 2024 because it shows operating profitability is extremely high. Meanwhile, the margin in previous year was very weak and the operating profitability was very low. A high operating profit margin is preferred. Now, we will calculate the net profit margin. The formula is net profit per sales times 100. For the year 2024, the net profit margin is 63.07%, and for the year 2023, the net profit margin is 4.55%. Overall, profitability is outstanding. This represents a high of percentage of sales, which is a massive improvement for the year 2024. Meanwhile, the previous year represent overall profitability very weak because only a small percentage of sales reach the bottom line. A higher net profit margin indicates a more profitable company that has better control over its costs. Now, I will continue to calculate the total debt ratio. The formula is total liability per total asset times 100. For the year 2024, the total debt ratio is 15.43%, and for the year 2023, the total debt ratio is 28.71%. The company used a very little debt and it shows excellent for year 2024. Assets are primarily financed by equity, indicating low financial risk. Meanwhile, the company's debt level was healthy and manageable. Debt financing was moderate, providing good financial flexibility that was higher than the current year. More debt financing result in more financial risk for the firm. Now, why should Ajinomoto is recommended for potential investor? The reason for recommendation is yes, Ajinomoto is recommended for potential investor because first one is strong financial performance, consistent sales and profit growth show financial stability. Second, good shareholder value, share buybacks, and strong institutional confidence increase stock value. The third is regional growth potential. Strong market presence in Southeast Asia ensures long-term growth. For the conclusion, based on Ajinomoto's strong financial performance, diversified business expansion, commitment to sustainability, and solid market position in Asia, the company demonstrates long-term growth potential and stability. Therefore, investing in Ajinomoto is a wise strategic decision for potential investors seeking a reliable and sustainable return on investment. That's all from me. Thank you.